Imagine waking up one morning, heart pounding in your chest, to a financial nightmare that feels utterly unreal. You started with what seemed like a modest, even sensible $500 investment, a sum you could afford to lose, or so you told yourself. But this morning, your phone buzzes with a notification that rips the floor out from under your entire world. It's not just a message saying your $500 is gone. Oh no, that would be a mercy. Instead, the screen glows with a chilling, stark message. Your account has been forcibly liquidated. Immediate deposit of $50,000 in short margin required, or legal action will be pursued. $50,000. You stare at the numbers, your brain scrambling to comprehend. $50,000 in debt. This is not a loss of your initial capital. It is a demand for a sum 100 times larger than you ever put in. A sum that could shatter your financial future, impact your family, and haunt your every waking moment. This isn't some obscure, fantastical plot point from a dystopian horror film, or a digital scam pulled by a faceless hacker. This, my friends, is the brutal, terrifying, and very real mechanism of the leveraged futures market. This is a financial arena where the rules are not only stacked against you, the very structure allows you to lose not just everything you invested, but potentially everything you own and more. Welcome to the Futures Trap. In an age saturated with digital hype, where viral success stories proliferate faster than wildfire, it's easy to get caught in the intoxicating current. We live in a world that constantly broadcasts the dizzying highs. There's the crypto millionaire who turned a few $100s into a Lamborghini. There's the high-frequency day trader who consistently beats the market. We hear about the early adopter of a meme stock who retired at 30. These narratives are almost mythological in their allure. They paint a picture of effortless wealth, of smart people making smart moves, transforming small capital into a vast fortune. This is often achieved by wielding the power of leverage. And why wouldn't you believe them? Everyone talks about the winners, the chosen few who cracked the code, who outsmarted the system. But here's the rub, the unspoken truth that rarely makes it into the glossy headlines or the triumphant social media posts. Very few, if any, speak of the countless others. These are the ones who didn't just lose their shirt, but lost the entire wardrobe, the house it was in, and the land it sat upon. They are the ones who wake up to that chilling notification. Their dreams of instant wealth curdle into the sour taste of devastating debt. The promise of amplifying your gains, of making your money work harder, faster, and more aggressively is incredibly tempting. It taps into a primal human desire for more, for better, for quicker. And on the surface, the mechanism seems so elegantly simple. What if you could control 10 times, 100 times, even 1,000 times more assets than you actually possess? Imagine the profits. But like so many things that sparkle with such an intense, almost unnatural brilliance, there's a dark, dangerous undercurrent. To truly understand this danger, we need to peel back the layers. Let's briefly journey back in time to the innocent, almost wholesome origins of futures contracts themselves. This isn't some modern invention cooked up in the digital labs of Silicon Valley. We're talking centuries ago, to the 1700s, specifically to the bustling Dojima Rice Market in Japan. Think of it, farmers, merchants, traders, all converging. Their lives were intrinsically linked to the volatile fortunes of the rice harvest. A bumper crop meant prices would plummet, potentially bankrupting farmers. A failed harvest meant prices would skyrocket, leaving merchants unable to afford staple goods. It was a chaotic, unpredictable dance with nature. So, they devised a brilliant solution: futures contracts. Farmers could agree to sell their rice months in advance at a predetermined price. This locked in their income and hedged against a future price drop. Merchants could agree to buy rice months in advance at a set price. This ensured their supply and hedged against a future price surge. It was a pure protective instrument. It was a beautiful insurance policy designed to stabilize economies, manage risk, and provide a much-needed layer of predictability in an unpredictable world. There was no intent for speculation or overnight riches. It was about stability. Fast forward a few centuries, and that beautiful insurance policy, that elegant mechanism for risk management, has been fundamentally transformed. The fatal introduction of widespread leverage, the ability to control large sums of money with a small deposit, has twisted its very purpose. What was once a shield has become a sword. In the hands of the uninformed, it is a devastating weapon, pointed directly back at them. The serene, predictable waters of risk management have been churned into a maelstrom of hyper-speculation. Fortunes are made and lost in the blink of an eye. The stakes are far, far higher than anyone ever warns you about. This is no longer about hedging your bets. It's about gambling everything you have and then some on the flip of a coin that you don't even realize is weighted against you from the start. This transformation did not happen overnight, but its effects are profound. The essence of a futures contract remained. It is an agreement to buy or sell an asset at a future date for a predetermined price. What started as a way for actual producers and consumers to manage real-world supply and demand risk morphed into a playground for financial engineers and speculators. But the accessibility, the ease, and critically, the sheer scale of leverage available to the everyday retail investor through digital platforms changed everything. Now, instead of a farmer in Dojima seeking stability, you have an individual sitting at their kitchen table, laptop open, scrolling through charts. They have the power to command hundreds of thousands, even millions of dollars worth of assets, with just a few thousand of their own. It's intoxicating, isn't it? The sheer power, the feeling of being able to play in the big leagues, to finally get a piece of the action. This illusion of control, amplified by the stories of those who got lucky, is what truly sets the trap. It lures you in with the siren song of exponential gains. It whispers promises of financial freedom, while carefully concealing the sharp, unforgiving teeth of its true nature. The context of the market today is also crucial. We are in an era of unprecedented access to financial markets. With just a few taps on a smartphone, you can open an account, deposit funds, and within minutes be trading highly complex leveraged derivatives. The barriers to entry have virtually disappeared. Unfortunately, the barriers to understanding the profound risks have also been eroded. There are countless influencers, gurus, and platform advertisements that trumpet the potential for astronomical returns, but rarely, if ever, do they dedicate equal airtime to the catastrophic downside. The ease with which one can enter this market belies the extraordinary complexity and inherent dangers that lie beneath its shiny, user-friendly interface. This isn't just a casual online game, it's a high-stakes professional arena. You are being invited to play with very sharp knives, often without knowing how to hold them. At the heart of this dangerous transformation, at the very core of what makes leveraged futures trading such a potent and destructive force for retail investors, lie two concepts that sound deceptively simple: leverage and margin. They promise you the illusion of power. They offer the ability to play with sums far beyond your actual capital, to operate on a scale usually reserved for titans of industry. Here's how it works. An exchange, whether it's for Bitcoin futures, NASDAQ futures, or crude oil, allows you to control a far larger amount of assets than you actually possess. Let's say you want to control $100,000 worth of Bitcoin. Instead of needing $100,000 in your account, the exchange might only ask for $1,000 as an initial margin deposit. This isn't a down payment. It's a security deposit, collateral, a good faith promise that you can cover potential losses. This arrangement provides you with 100 times leverage. For every $1 you put in, you control $100 worth of the underlying asset. The immediate psychological appeal is immense. Imagine the feeling. Your small investment suddenly commands a mighty position. You envision multiplying potential profits at an exhilarating rate. A 1% move in the market in your favor could, in theory, yield a 100% profit on your initial margin. It feels like you've unlocked a cheat code to wealth. But this, my friends, is the double-edged sword of amplification. It cuts with brutal efficiency in both directions. Crucially, leverage doesn't just magnify your profits, it equally, and often far more rapidly, magnifies your losses. That same 1% move in the market, if it goes against your position, doesn't just mean a 1% loss on your initial $100,000 exposure. It means a 100% loss on your $1,000 margin. In a matter of seconds, your entire initial capital can be wiped out by a minuscule price fluctuation. This isn't hypothetical. It's the fundamental mathematical reality of highly leveraged trading. Let's illustrate this with a real-world, albeit fictionalized, example. Meet Sarah. Sarah is an average investor, perhaps a school teacher or a graphic designer. She has diligently saved $50,000 over years of hard work. She's been hearing the hype, seeing the headlines about Bitcoin soaring or the Nasdaq hitting new highs. Tempted by the promise of rapid gains and perhaps a little bit of fear of missing out, she decides to dip her toes into the futures market. She opens an account and initially starts with what she considers conservative leverage, perhaps 2 times or 3 times. This means with her $50,000, she controls $100,000 to $150,000 worth of the asset. For a few days, Sarah experiences the taste of victory. The market moves slightly in her favor. Thanks to her modest leverage, her $50,000 grows to $60,000. A $10,000 profit in just 2 days. It feels incredible. A surge of dopamine rushes through her system. But then, the dangerous thought creeps in, insidious and seductive. If I made $10,000 with just 2 times leverage, what if I had used 100 times leverage? I could have made $500,000. This is the moment the trap begins to tighten. Fuels an insatiable desire for more, for faster. Sarah, emboldened by her early success and convinced she understands the market, decides to switch to maximum leverage, perhaps 100 times or even 200 times, depending on the platform. With 100 times leverage, her $50,000 now controls $5 million worth of assets. She feels invincible, standing on top of the world. Now, let's describe the frantic, heart-stopping 10-minute period that follows. Sarah's initial trade with maximum leverage starts well. The price of Bitcoin or the Nasdaq futures contract ticks up by just 0.5%. For someone using 100 times leverage, that's a 50% profit on her initial $50,000 margin. In mere moments, she sees her account balance jump to $75,000. She's elated, her heart pounding with a mix of excitement and adrenaline. This is it, she thinks, financial freedom. But then, without warning, the market turns. Perhaps it's a sudden negative news release, a large institutional sell order, or just a typical volatile swing. A sudden drop or a flash crash begins. The price, which just moments ago was gracefully rising, suddenly plummets. It drops by 1%, then another 3%. In under a minute, her substantial gain has turned into a devastating loss. As her account equity falls below the exchange's predefined maintenance margin requirement, she receives the dreaded notification, an automated margin call. Her screen flashes with a stark warning. Your account equity is below maintenance margin. Deposit additional funds immediately to avoid liquidation. Sarah's mind races. Panic sets in. She's caught in an agonizing internal conflict. Should she cut her losses now, acknowledging her mistake, or desperately hope for a rebound, clinging to the belief that the market will surely turn around? This internal battle, this hesitation, creates fatal delays. She might scramble to find more money or just stare at the screen, paralyzed by fear and disbelief. Every second counts. But the market, cold and unforgiving, doesn't wait for her. As the price continues to drop, pushing her account further into deficit, the exchange automatically initiates the brutal process of forced liquidation. This is not a polite request. It is an immediate, algorithmic execution. The exchange, protecting its own capital, automatically sells her entire position at current market prices to cover its loan to her. And here's where another layer of predatory mechanics comes into play: slippage. In fast-moving, highly volatile, or illiquid markets, especially during flash crashes or sudden drops, there might not be enough buyers at the price the exchange wants to liquidate Sarah's position. This means the actual execution price of her sale can be significantly worse than the current displayed market price. It can even be worse than the price at which her maintenance margin was breached. It's like trying to sell a rapidly depreciating asset in a panic. You don't get the sticker price. You get whatever someone is willing to pay right now, which is often far lower. The exchange, in its haste to protect itself, will hit every available bid, pushing the price down even further as it liquidates large positions. So due to this slippage, Sarah's initial $50,000 is not only completely gone, her trade executes at a price so low that she now owes the exchange an additional substantial sum. Her $50,000 savings are annihilated. Now, the screen shows a negative balance. She owes the exchange $50,000 more. The ultimate insult, the cruel irony, is that the price often recovers sharply, sometimes immediately, after her forced liquidation. The market, having flushed out all the weak hands, often bounces back. This leaves Sarah watching, utterly ruined, as the very asset that destroyed her suddenly rises again, just out of her reach. Let's delve deeper into maintenance margin and negative equity, because understanding these terms is paramount to grasping the true peril. Exchanges operate under a fundamental principle. They will always protect their own capital first. When you trade with leverage, you are essentially borrowing money from the exchange. Your initial margin is collateral for this loan. The maintenance margin is a critical threshold. It is a minimum amount of equity you must maintain in your account to keep your leveraged position open. It's usually a percentage of the total value of your position, lower than the initial margin requirement. For instance, if your 100 times leveraged position of $5 million in Bitcoin falls to a point where your $50,000 margin is almost entirely depleted, say only $2,500 remains, the exchange will issue a margin call. This is their warning shot. It tells you your collateral is almost gone. If you fail to deposit additional funds to bring your account equity back above the maintenance margin, the exchange will automatically liquidate your position. This is not a favor. It's a self-preservation mechanism. They sell your assets to recover the borrowed funds. But, as we discussed with slippage, in a rapidly moving market, especially one where many other leveraged traders are also being liquidated, the price can fall so fast and so far that the exchange liquidates your position at a price below what is needed to cover their loan to you. When this happens, your account goes into a negative equity position. You don't just lose your initial deposit, you now owe the exchange the difference. This isn't a loophole or a rare occurrence. It's explicitly outlined in the terms and conditions that every trader agrees to when opening an account. It states that you are liable for any negative balance that results from leveraged trading. Rapid market movements combined with slippage are the perfect storm that can push a trader into owing money far beyond their initial deposit. The exchange's systems are designed to minimize their risk, not yours. They have no emotional attachment to your capital. Their algorithms are cold, calculating, and efficient. The speed of the modern market, the algorithmic nature of trading, and the unforgiving mechanics of leverage mean that this entire catastrophic sequence can unfold in minutes, if not seconds. This leaves you with devastating, life-altering debt. Imagine that your $50,000 savings was all you had for a down payment on a house, or your child's college fund, or your emergency medical savings. In the blink of an eye, it's gone. Now you have a $50,000 debt hanging over your head. This isn't just a financial loss. It's a personal catastrophe, born from the deceptive allure of a market mechanism that amplifies risk just as readily as it promises reward. This is the futures trap, laid bare for all to see. The impact of leveraged futures trading extends far beyond the immediate financial devastation. It infiltrates the very psychology of the individual. It warps their perception of risk and reward. It creates a dependence that can be as powerful and destructive as any addiction. The intense dopamine rush from amplified gains, even small ones, fundamentally rewires the brain. The initial hit of a 50% gain on a 0.5% market movement creates a high, a sense of invincibility. It is unlike anything most retail investors experience in traditional markets. This isn't just about money. It's about neurochemistry. Your brain begins to associate extreme risk with extreme rapid reward. This makes the steady, single-digit returns of traditional investing seem utterly boring, even pointless. Why wait years for a 10% gain when you can achieve it in minutes? Or so the delusion goes. This fosters an insatiable desire for higher leverage and greater risk. It leads to destructive trading patterns where prudence is discarded in favor of adrenaline. The best case scenario here is that an investor recognizes this psychological trap early. They understand the neurological pathways being exploited and step away before the addiction takes hold. The worst case is a descent into a relentless cycle of chasing increasingly risky trades. Each loss fuels a desperate need for a bigger win to, quote, get back to even. This ultimately leads to profound personal and financial ruin. But beyond the internal battle, there's an external one. An inherently unfair battle waged by market giants against the small, unsuspecting retail trader. You see, when you enter the leveraged futures market, you are not just competing against abstract market numbers, charts, or economic indicators. Your true opponents are colossal institutions. They are equipped with state-of-the-art artificial intelligence trading algorithms. They also have what are known as whales. These are individual players or funds with billions in capital. They have real-time visibility into order books. They often have an uncanny insight into where clusters of smaller traders have placed their positions. Consider the predator strategy known as stop hunting. Imagine a vast, sophisticated hunting ground. You, the small retail trader, are inadvertently laying out breadcrumbs leading directly to your position. That's what your stop-loss order often becomes. Most individual traders, relying on readily available technical analysis, place their stop-loss orders at similar, predictable technical levels, just below a key support level or just above a resistance. For institutions and whales, these clusters of stop-loss orders are a treasure map. They know that if they can collectively push the price down just a little further or up just a little higher, they can trigger a cascade of these stop losses. This leads to mass liquidations of leveraged positions. This creates a chain reaction. Forced selling by many small traders pushes the price even further in their intended direction. This allows the whales to scoop up assets at fire sale prices or profit handsomely from the engineered volatility. The best case for a retail investor is to understand this dynamic. They should realize that their perceived safe stop loss is often a target. They should either avoid this market or develop highly nuanced, non-predictable risk management strategies. The worst case is becoming another statistic, another liquidated position, fueling the profits of those who orchestrate these market movements. This leads directly to what are known as long squeezes and short squeezes. These are not organic market movements. They are coordinated attacks designed to exploit high leverage. When the market is predominantly long, meaning many traders are betting on prices to rise, whales can intentionally cause an extreme, rapid price drop, matter of minutes. This triggers mass liquidations of those long positions, forcing them to sell, which in turn drives the price even lower. The whales can then buy up these cheaply liquidated assets, profiting immensely. Conversely, a short squeeze targets traders betting on prices to fall, forcing a rapid upward price movement to liquidate their short positions. For the retail investor caught in such a squeeze, the outcome is almost always catastrophic. Their capital is annihilated. Their dreams of profit crushed by a market that has been deliberately manipulated. Given this reality, the futility of relying solely on technical analysis in these highly leveraged futures markets becomes starkly apparent. While technical analysis has its place in analyzing more stable, less manipulated markets, relying on it as your sole guide in an arena dominated by whales and algorithms is often an exercise in self-deception. You meticulously drawn chart patterns, your support and resistance lines, your moving averages. These can become not your guide to safety, but their hunting grounds. The very levels you identify as crucial for decision-making are often the precise points where large players will initiate their stop hunting or squeeze maneuvers. The market is not always moving based on supply and demand. It can be engineered by those with the capital and technology to do so. The best case here is to recognize the limitations of technical analysis in highly manipulated environments. Seek broader, fundamental understandings of market structure. The worst case is clinging to the belief that pure chart reading will protect you, only to find your patterns utterly obliterated by forces beyond your control. The psychological toll of engaging in this game is immense. It begins with panic, a primal fear as your hard-earned capital evaporates. This panic makes rational decision-making almost impossible. The investor often enters a spiral of desperation. They desperately pour more money, emergency funds, lines of credit, even money borrowed from family, into a losing position. They are convinced that the market must turn around, that their initial conviction must eventually prove right. But the market shows no mercy. Each additional deposit is often just more fuel for the fire, further trapping the individual in a self-destructive cycle. The best case for an investor observing this spiral is to recognize the patterns of financial desperation and intervention that can lead to deeper losses. The worst case is to experience this spiral firsthand, leading not just to financial ruin, but also severe psychological distress, broken relationships, and lasting trauma. So what is the unvarnished truth? The core message that we must take away from this stark look into the leveraged futures market. It is this: leveraged futures trading, while appearing to offer unlimited upside potential, carries the very real and terrifying risk of unlimited downside. A small initial investment, far from being an acceptable risk, can leave you with life-altering debt, a debt that can haunt you for years, if not decades. The nightmare scenario of owing $50,000 after investing $500 is not a hypothetical horror. It is a documented reality for countless retail traders. We offer this information not as mere financial advice. You should always consult with a qualified financial professional for your specific situation. This is a critical survival guide. It is a map for navigating the often predatory financial jungle of modern capital markets. It is about understanding the landscape, identifying the traps, and recognizing the true nature of the creatures that inhabit it. Therefore, for the vast majority of retail investors, the smartest and safest investment one can make is unequivocally not to participate in leveraged futures trading. Protect your hard-earned capital by simply avoiding a game that is fundamentally designed to transfer wealth from the many who are lured by the promise of easy riches to the few who possess the capital, technology, and ruthlessness to exploit the system. Resist the siren song of rapid riches. Resist the allure of amplified gains that come with amplified asymmetrical risk. Instead, focus on disciplined, long-term investment strategies that respect risk, prioritize the preservation of capital, and build wealth steadily over time. Imagine waking up one morning, not with your heart pounding in your chest from a financial nightmare, but with the quiet confidence that your financial future is being built on solid ground. It is protected from the brutal, unforgiving traps of the leveraged futures market. That, truly, is the wisest investment of all.